With federal loan rates at some of the highest levels we've seen in years, a lot of borrowers are wondering if refinancing could help them save. Refinancing with a private lender could lower your rate and your total repayment amount. Here's how. When interest rates drop, it might be a smart time to refinance, especially if your current rate is higher than what's available now. Take this example. Say you have $60,000 in student loans at 8.08%, the typical rate for federal grad loans right now. You pay about $731 a month over 10 years. Refinancing that to 7.29%, less than a 1% drop, brings your monthly payment down to about $706. That small change adds up to nearly $3,000 in savings over the life of the loan. And more of your money goes towards what you actually borrow instead of interest. When interest rates drop, it's a good time to reevaluate your student loans. Refinancing could help you lower your monthly payments, pay less overall, or both. Want to dig deeper? Check out our blog article on why lower interest rates are good for student loan refinancing. It's full of helpful tips and real examples to help you make an informed decision.